What is going on, everyone? Hey, it's me. It's Chris Painter at Keller Williams Realty, and I wanted to bring on today someone that I have known for a little while,
Yeah.
Nicole Soares. She is the owner of B Squared Credit. She's a credit expert with over 30 years experience, and helps people clean up their credit because the biggest thing I get when I'm consulting with some of you as new buyers, you keep telling me my credit's terrible, my credit's terrible. So I thought, you know what? I want to bring on Nicole. Nicole is someone I trust. Nicole is someone that helped me and helped other people. So, Nicole, thank you for joining me today.
Thanks for having me. I'm excited to be here.
Thank you. Thank you. So, tell us a little bit about yourself before we get into it.
Okay. So you did a great job on my introduction. I actually started at Bank of America at 16 years old and just slowly worked my way up to the vice president of the fraud department and just learned every aspect of banking, right? Like how to read a credit report, how to underwrite loans, to risk management. You and I were talking earlier before we jumped on about credit line increases and decreases. I used to help run which accounts are we going to close and which credit limits are we going to decrease based on risk and different variables. And when I left there as vice president of fraud, I was really heavy into the analytics and understanding. We were users at that time of analytics that FICO Fair Isaac produced, both for credit and for fraud risk, right? So it when you're getting these large volumes of transactions or applications, when you use an analytical tool like that, it gives you a score, and that score is very predictive to understand how likely something is to happen. Either how likely is that transaction fraud, or how likely is that application the true person, or how likely is this person to repay the credit card if you approve it. So,
Mm-hmm.
really got into analytics, loved it. And I was actually approached by FICO, Fair Isaac in San Diego. I was living in Arizona at the time. And they said, well, would you be interested in coming out here to interview? And I remember thinking it was like on my dream list of like where to live, right? It was about 2000, the year 2000. And I just thought, well, yeah, of course I'll fly out there for that. So 2 weeks later, I sold my house, bought a house, and ever since I've been in
Nice.
San Diego and just loved working for FICO. I worked there actually helping develop products, and I covered Europe, Middle East, and Africa. And I would go out to
Mm.
all the banks and retail locations that used our analytical products to help enhance them, better help our clients better utilize them, but also bring back knowledge to our development team to figure out how do we improve our models and accuracy over time with outliers and kind of unique situations that our clients were seeing. So
That's
then
awesome.
yeah, eventually decided, I got my degree in business. I always wanted to be self-employed. I had a young family, had kids to provide for, so it was kind of scary transitioning from the corporate world to being self-employed.
I
Uh,
get it.
yeah, but 10
I get
years
it.
ago, finally happened, and that's when B Square Credit, the company I work for, I own, was born.
So I didn't know FICO was here in San Diego. They're based here in
Yeah.
San Diego.
Yeah, the headquarters is in Minneapolis, but we
Oh,
had a
okay.
very large division. If you're familiar with like the 5 and the 56 freeway, we
Yep.
had a large fraud division there. So all of the analytics for
Oh,
fraud
okay.
come out of that group.
Oh, interesting. Interesting. I did not know that. See, I learned something new every time I talk to somebody. And
Yeah,
I've been in San
they
Diego for 30 years.
acquired a company here that was
Okay.
fraud analytics, and that became part of FICO. So that's why I think it ended up staying in San Diego.
Oh, cool. Very cool. Well, you learn something new every day.
Yeah.
So let's talk for a quick second. I sell houses, and in order to get a house, you need a mortgage. And in
Yep.
order to get a mortgage, you need credit. I mean, that's
Yep.
just the way it is. I mean, sometimes I think, there's a lot of people who subscribe to the Dave Ramsey theory, pay cash for everything. But, when your housing prices are $1 million in San Diego, it's hard to put $1 million in cash away. So we have to
Yep.
use other people's money, right? So when a client comes to you and they say that their credit isn't so great, what's the first step in starting that cleanup process, so that way they can be, so that way they can be put on that road to buying a house? What does that look like?
Yeah. First of all, most of my business comes from loan officers and realtors, right? So I'm so blessed to have these partnerships. When one of those partners send me a client, they usually will do the introduction via email, and they'll say, you know, we need, especially if it's a loan officer, we need a 680 middle score for the loan program we're trying to qualify this person for. Or maybe it's a VA loan and we only need a 620 middle score. So, you know, in the mortgage situation, they pull TransUnion, Equifax, and Experian, all three
Mhm.
credit bureaus. They drop the low and the high score, and they price the loan off the middle score. They use
Mhm.
all the data from all three credit bureaus, but scoring wise, they use the middle score. So when I get that report, a lot of times they'll come with a report, and if not, then we'll do a soft pull of a credit report. And a soft pull just means that somebody is pulling their credit report for educational purposes. It doesn't hurt their credit score at all. Versus what a loan officer does, they're taking an application and they're doing a hard pull. Anytime
Mhm.
an application is processed, then that hard pull can impact their credit score. That's a big distinction that there's confusion around. So again, we're doing it for education purposes. We're going to look at that credit report. And you know, one of the hardest things is understanding the credit score. So
Mhm.
somebody comes to you and says, "Hey, Chris, I got a 700 credit score. I want to buy a house." Your question should be, "That's great. Where did you get the credit score?" Right?
Exactly.
Because not all credit scores are equal. So
Correct.
let's pretend the answer of Billy Joe to Chris is, "I got it from Credit Karma," which is common. It's a free tool. Everyone likes to use it. There's a lot of great
Right.
marketing. So I like that. But now I know that I'm using a fake score, right? I'm using a Vantage branded credit score. There's actually multiple brands of credit scores. And so with that, I know that that credit score may not be accurate, is likely to not be accurate. And when I say accurate, I guess I just mean it's not a FICO branded credit score. And FICO is the credit score that 90% of loans are decision based off of. And when FICO can be 100 points lower than a credit score, a Credit Karma that they provide you, which is Vantage score, it matters, right? So
Yes.
I figure out what
It's a
score.
big deal.
Yeah, it's a big deal. It could be 5 points, and actually, FICO could even be higher. So there's it's not black and white, but I just am trying to figure out. Okay, I don't want to say to my client, "No, you're wrong." I just want to
Mhm.
understand where they're getting it, so that I can do a little bit of education around. Okay, that's great. You know, you're getting a different brand of credit score than your loan officer is using. So let's go ahead and pull a report, or let's try to dive into the actual data and figure out how to set some goals and help you improve.
Mhm.
I might not even get the FICO credit scores for that client, but I know how the weighting of these two scores are different. And
Mhm.
therefore, I kind of have a good understanding. Okay, if you're a 680 advantage and you have these types of credit issues, then your FICO is likely 100 points lower. So I don't know,
Gotcha.
maybe getting a little too technical, but ultimately the credit brand matters. Now I'm going to look at the report. And when I look at the report, I'm looking for all the different possible reasons a credit score could be low. It could
Mhm.
be because you have negative marks. It could be because you don't have any credit or very
Mhm.
little credit. It could be that you have maxed out credit cards, right? It could be that you have really young credit. You don't have mix of account types. There's so many variables that impact a credit score. So, as an expert, I'm looking and I'm analyzing very quickly, and I'm saying, okay, for this consumer, I know that we need to do some credit repair to challenge and remove some of the negative items. We know that makes up 35% of the credit score. And I know that this person needs to open one or two credit cards because they don't have enough good credit,
Mhm.
and maybe even sometimes add rental history. So I'm just going through that list and customizing a plan for every client as part of our free consultation.
Awesome. Let me ask you, when you say that they may need to open a credit card or two, and let's say part of the reason their credit is low is because they have no credit. There's some
Right.
people who just really don't have a lot of credit.
Yeah.
Are you saying that it's okay to get a secure credit card? Because I've heard that secure credit cards are bad. I just want to kind of clear that just to make sure.
I would just say all products are not equal. So when we open a card, it's fine if it's secured or unsecured. And what's the difference? The secured just means I'm a higher risk. The bank doesn't want to qualify me. Therefore, they want me to put a deposit down to
Hmm.
securitize my credit line.
Hmm.
That credit limit, let's say I put $500 down, they're going to give me a $500 credit limit. That $500 is just, think of it like it's in a savings account. It's just frozen. No one's going to touch it. I'm not, they're not. But if I was to default, they're going to take my money and pay themselves back. But if I don't default, a lot of companies will actually give me my deposit back and convert that to an unsecured card and allow me to keep that same account with the original open date, which is great because
Yep.
account maturity is a good part, important part of your credit score. So we don't want to be opening and closing accounts. So if we can keep the original open date, that's helpful.
So, so why does the number itself matter so much? Because it's like this, it's kind of this, it's almost, it's so hard to understand. Why does the number matter so much?
The credit score.
Yes.
Yeah. So years ago, banks used to not give equal opportunity, right? So we'll just talk about the 60s and probably 60s, 70s. FICO didn't come out until I think 85, 86. So you were the branch manager and you approved who? Your friends and family, right?
Right.
And your neighbor. So there was all this problem with lack of equal opportunity, and therefore FICO came in and said, I'm going to not be a data company, right? They don't manage data, but I'm going to create analytics and I'm going to apply my score to the data sets at TransUnion, Equifax, and Experian. And so you're going to have three credit scores because the data differs. And I'm
Hmm.
going to make a score that's predictive that banks can rely on and use that to decision equally. And I'm not, and FICO does not, you look at what you do for work, your age, your skin color, your sexual preference, right? They don't use any of that. They use they use your historical credit data.
Hmm.
But interesting enough, they predict your risk not only on your behavior, but people like you. That's what I think is interesting.
Interesting.
So I'll give you an example I see a lot. So Chris, if you like to go take out high risk unsecured installment loans, let's just call them payday loans,
Okay.
you may pay your payday loans back, but
Mhm.
because you're behaving risky, your credit score is going to be negatively impacted because people like you that take out high risk loans often don't pay them back.
Oh, now see, I would think that would be the opposite because you're trying to build up your credit. But that makes perfect sense.
Right. So if you're going to get a secured installment loan, like an auto, that's very different in your risk level, which is why it's priced lower, right? You have a lower interest rate because interest rate is risk based pricing, right? The
Right.
higher probability that you'll pay something back, the lower your risk, and therefore the lower the fees that the banks will charge, generally speaking. So if you're going to go take out a high risk payday loan at 30% interest, the likelihood one that you're going to repay that because it's so darn expensive with all the fees is much lower,
Hmm.
and you're grouped in with risky behavior, and therefore your credit score will be negatively impacted. Not all credit is equal.
Wow. Now, okay, I just again learned something else that I didn't know.
Yeah.
So let's so we touched a little bit on this. You had said when credit bureaus go to figure out that number, go over again
Okay.
exactly how they kind of get to that magical number. If we have to get to, let's say, a 700 to get to a specific loan product, what is it that we're looking for? And what is it that I can do as someone who needs credit repair, let's say, to be doing to move that number up as much as I can?
Okay. So first of all, TransUnion, Equifax, and Experian all have unique data, right? Because creditors provide data to each of them, but it's not required that a creditor reports or a collection agency to all three credit bureaus. For an example, if you get a parking ticket in San Diego and
Mhm,
it goes to collection, you don't pay it, it's
mhm,
only going to show up on your Experian credit report. Okay. So when we're going for a very large loan, it's going to minimize the risk of the lender if they purchase all three credit bureaus, And then
Mhm.
FICO comes in and overlays their credit score at each bureau. And now you get all three credit bureaus and all three scores. When I analyze that to say, okay, Chris's clients has 680 and we want to get that person to a 720 for better pricing and better loan terms and save a lot of money. Now what I'm looking at is a pie chart. I'm thinking of a
Okay.
pie chart. So the pie chart represents the credit score. And let's just kind of go through that. I should probably put my little cheat sheet up. So when I get to the 10 and 15%, sometimes I say I'm wrong. So 35% of your credit score is, do you pay your bills on time?
Mm-hmm.
When I go into that, I go a little bit deeper, because let's pretend your client has an auto repo and they're
Mm-hmm.
in California and
Mm-hmm.
it's 2 years old.
Mm-hmm.
They could have a judgment. So we want to make sure that, one, we stabilize that account, and we also determine if there's a judgment, because credit score is one line of approval process that you have to go through, but there's always the second phase, and that's called the underwriting criteria. And the underwriting criteria, it says you can't have any unpaid judgments, right? So I'm looking at things from a score and also a little bit deeper than that. So if it's unstable, derogatory credit, I treat it different than stable. Sometimes it's credit repair, sometimes it's settlement services. Okay, sometimes we don't touch it at all and we let that naturally mature while we're focusing on different aspects of the credit score that help the client improve their credit. Okay,
Mm-hmm.
so derogatory matters, biggest part, 35%. So what's remaining on the credit score? 65%.
Mm-hmm.
65% is basically good credit. This is where I get the most frustrated with our industry, credit repair, because a lot of folks will focus on the credit repair, the 35%,
Mm-hmm.
but they forget about the 65%. So if I'm not coaching and educating my clients on tasks they can do to help improve the rest of their credit score, and we'll go over that in a second, then I'm really not doing the right service for the clients, because they're not getting the education they need to understand what else they can be doing to further raise their scores. So let me give you some examples of that. So the next part of the pie chart is 30%. How much of your open to buy on your credit limits, so how much of your credit limits are you using? So let's pretend we have two credit cards and they total $5,000 of balances. You gonna write this down?
I gotta close my door.
Oh, okay. I know. I've got the background noise too. I'm hoping you can't hear. So, okay. So we have two credit cards. Our balances are $5,000. Our credit limits are $10,000. So right now I'm trying to calculate what percent of my credit limits am I using?
Mm-hmm.
50%, right?
Okay.
That's
Mm-hmm.
too high. We want to see our clients under 20%.
Okay.
And why? Because our credit score tells the lender how likely somebody is to default. If you're living beyond your means and you're charging a bunch of credit card debt that you can't afford to pay back, you are a higher risk, right? So we want to retrain our credit score. One of the very first easy things to do when somebody has credit card balances is say, let's get these paid down under 20%, and even 5% is even better, right? So if somebody goes, well, I heard 30%, I heard 20%, get it down to 5%, right? Because the lower it is, the higher probability that you are going to pay back your loan. So we want it to be as low as possible. So if you're missing out on the 30% because you don't have any open credit cards, that can be an easy solution, right? We need to get one or
Mm-hmm.
two credit cards and we need to start credit building. We don't want to max them out. We want to pay them on time.
Mm-hmm.
And there's another technique where we can get added as an authorized user to a friend or family member's credit card. They can cut up the card. We never have to use it. But if it's a really good account and it gives us account maturity and it gives us open to buy, that could be really helpful in driving somebody's credit score up quickly if they went from no credit cards to all of a sudden a credit card of their own and becoming an authorized user. Let's pretend on an account that's 10 years old. I mean, that could literally be 50 to 80 points of a credit score improvement within 30 to 60 days if those two things happen.
Interesting. Interesting.
Yeah.
Now let me step back for a second, because you had mentioned settlement services, and there are some people that uh
Now I
you
have to
know
close. I'm listening, but I have to close my door because it's getting really loud outside.
oh, okay, um that they've had defaults, right, on their credit cards.
Right.
Is it is it a good idea to settle those cards or just go to BK,
Yeah.
or what would
Yeah.
you what
Okay.
would you say?
Oh my gosh. So I mean, I could spend 10 minutes talking about this if you want me to. So tell me how deep you want me to go here.
Well, let's say, for example, because some people, they just don't pay their credit card bills, right? And if given the opportunity, is it a better idea to settle the credit card, or in some cases, is it just better for somebody to file BK and start fresh at the bottom and work your way back up?
So let's assume they're still trying to go for the goal of improving their credit so they can get a home. Okay, because
Correct.
it's a very different response if you just have somebody that's coming to me that's trying to recover from a life event. They
Mhm.
have a bunch of defaulted accounts or some that are about to default. We're really trying to minimize the impact and stabilize things so that we can start improving, right? So you got to kind of put the horse before the cart in the sense that we have to stabilize some things first in that situation. So I'm going to try to answer your question without going too deep. So when you default on an account, let's say a credit card, and let's say you go 4 to 5 payments past due, the bank has to get it off their balance sheet, and they do that at that point by charging off the account. So on the credit report, it'll say charge off.
Okay.
Charge off, let's say you have an American Express account, went 4 payments past due, the balance is still reporting, but now it shows default, but it shows charge off, AKA default. That's all that means. You still owe it, right?
Mhm.
Now, let's take California. Now the 4-year statute of limitations starts from the time that the account, the last payment generally, from the last payment date for 4 years, Amex has to sue that client. They could go to Superior Court and they could pursue a civil judgment against the client. If they get that judgment, then for 10 years, they can garnish wages or levy any bank account in their name to get
That's a
their
long
money,
time.
plus court fees and attorney fees. Exactly. And now they're not going to settle the debt really because
Mhm.
they got you, right? Now
Mhm.
you can't
Mhm.
get a home loan because you have an unsatisfied judgment. So if it's a charge off, we want to look and see if I think they're at risk of getting sued. Right? I've been doing this long enough. I know who's likely, the dollar amount, dates, all kinds of variables. That's possibility one. We want to avoid that at all costs. The next is that they decide they don't want to sue and they're just going to sell that debt to a collection agency. So now we have a charge off transfer on the original account with Amex, zero balance owed. And then now we have ABC Collection Agency, whatever the name is, reporting now a collection for that account. So the client's getting double dinged because they have the charge off, which will report for 7 years, and now a collection.
Oh.
In that collection, sometimes we can do credit repair to challenge it and get it removed, and we wouldn't want the client to pay it. But there's times where we say, really, this is one that you could settle. And if you chose to, we may be able to negotiate the deletion of the collection as part of that settlement arrangement. So for pennies on the dollar, you get it settled and you get that collection removed. That's a huge benefit to a credit score, right? But
Gotcha.
credit repair can also have the same impact where sometimes we'll challenge it and get it off and not have to ever settle it. But it just depends on a lot of variables. And that's really for us reviewing it and using our expertise, that's really where it's helpful to know when something should be paid and when it shouldn't be. The other option is they can hold on to it and just report it for 7 years and never sue you and continue to just collect on it.
Is that likely?
It is, and also there's one last option, and that's where you get 1099 for the debt. So they forgive the debt.
Mhm.
You have to pay taxes on the as the debt amount is forgiven. And in that situation, they're supposed to update it to a zero balance owed. But what I'm seeing is a lot of times the balance will still continue to report. So we can do a federal escalation on that situation to show the 1099 proof and demand, and we always go for a demand of a deletion of the trade line for misreporting purposes. Look, you failed to correct this on the report. We demand you just do a permanent removal. But the error really was the balance that was reporting incorrectly. You can't 1099 a client and say, I forgive you, and then turn around and still try to collect $10,000 for the
Yeah.
debt.
No, no. That's a no-no.
No. Yeah.
Well, so that's all good. Now let's say we're starting the process, right? Like today. Today we're starting the process. on average, how long would you say it takes to move this process along to start getting your credit score lifted or, increased?
So we have 9 different services that we offer because it's just not a one size fits all. We do student loan consolidation and modifications, rehabilitations. We do credit repair. Credit repair can take one day. I've got some techniques that are super quick, very rare, but we do all the way up to 6 months, 12 months. I mean, every file is different. But the average client, I would say, is 3 to 6 months in credit repair.
Okay.
Um, and we do, like I said, settlement work. We do federal escalations. The example I was just explaining, when we have documentation to prove something's misreporting, we'll just go right to the federal government and ask them to step in and oversee that. That's usually pretty quick. Within 30 days, we usually have that corrected. And
Okay.
then, as a last resort, we have a partner attorney that we refer out to. If we've tried credit repair and I have a fraud situation, this poor guy, since he was 9 years old, had his identity stolen. And in a completely different state, they ran up $50,000 of credit card debt.
Oh
He has
no.
tried and tried on his own with big names, Amex, Discover, Barclays, big companies. But his profile was so it was like a new identity for a credit report profile was created, and so nobody could really tell who the legit person was. But we provided identity documents and said, no, this is our client. Here's our identity. Here's what happened. Here's the police report. After 2 rounds of letters, half of it still wasn't fixed. So we just packaged it up, gave it to our attorney last week. He'll sue Barclays, he'll sue the bureaus, he'll sue Amex and Discover. And in that situation, the client will end up making a few $1,000s per account as part of the settlement. Not only will the credit issue get resolved, but he'll end up making money on that. That's frustrating. I hate to do it, but I'm grateful that we have that escalation in the rare situations we need to use it.
That's crazy.
So
That is.
every file is different, but and you have to also remember credit repair is not guaranteed, right? Some people are like, oh, I'd love to, but I want a guarantee. There's no guarantee. Majority of these issues are reporting accurately, right?
Mhm.
Yes,
Well,
we
it's like working out. If you don't put in the effort and you don't eat the right food, you are not going to have the hot summer body that you want, right?
well, that's a great analogy, and I like that especially for the coaching because we always include coaching with all of our services. Yes, I could do settlement work and I could do credit repair work, and I'm confident those things are going to be effective. I rarely get 100% of the negative items off.
Mhm.
I'm coaching you and I'm teaching you open this account, close this account, pay this down, do this, do that. You got to do your homework, right?
You got to do it too.
65% of your credit score, kind of like diet, 65% is what you put in your mouth.
Yep.
65% of your credit score is what, your behavior on your good credit. I will teach you. I've got so much information in this brain of mine, but you got to take the actions I give you. You can't rely on credit repair alone to get the credit scores that you deserve and that you're capable of.
Excellent. And one last question, because I think that, let's say, I got a good credit score now, and I know for sure my legit credit score is over 700 now, which is good because before it wasn't. So, um, for someone who's got a good credit score, what happens when you make your payment even one day late or a month late, or when does that start catching up
Okay.
to you?
Okay. So remind me, I want to tell you a captive analogy in just a minute, but I'll answer this question first. Um, okay. So your bill is due. Let's just take our credit card. We have a Bank of America credit card. Our bill's due on the 15th. Let's
Mhm.
pretend Bank of America gives us a 2-day grace period. These are old school accounts in my mind. So
Mhm.
you've got to look at what your grace period. And how do I know that is when my statement cycles. So when is my next statement cut? So I have a due date of the 15th. On the 17th, my next statement cycles, it cuts. That's when my data gets captured and Bank of America sends it to TransUnion, Equifax, and Experian to update my individual credit report. So they don't report you late for 2 days because we don't have a 2-day late on our credit report. You have to be 32 days late on, let's say, my Barclay card, or I'm sorry, my Bank of America card, before I'm going to get reported 30-day late. So people will go, I only paid that 1 day late. Doesn't really work that way. Right. And I said, okay, well, go ahead and give me the statement, send me the data. And then I look at it and I'm like, no, you're actually 31 days late, because the following month you have to be late again, and then it'll report you 30 days late.
Got you. Okay. Okay. I get it.
Yeah.
I get it.
But what's beautiful about that analogy or that story or scenario is that on the 17th, when my account cycles, that's when my balance matters. Not only did I pay it on time, but my balance, right? So if I'm trying to get the best possible score, on the 15th, maybe I paid my whole balance off, but let's say on the 16th, I went and charged a bunch of stuff. I want to make sure that, the lowest possible balance is getting updated to the credit bureaus. And so on my cycle date is when that really matters.
Oh, see, I learned something else.
Yeah. Okay, so I'm going
Oh,
to talk about catch up for a second. So I'm going to go back to credit scoring again, because you said something about what my real credit score is, and I just want to explain something. So you know how when you go to the grocery store and let's say you're throwing a birthday party for a kid, a friend, whatever, and you're going to the beach for the day because we live here in San Diego. It's going to be out in the sun, so probably at the end of the day we're going to throw our condiments away. So when we go there, we see Heinz. Heinz is like FICO. That's the brand of ketchup that wins all the taste tests, and it's what the restaurants carry, okay? Because clients love it. But you're not needing Heinz. You're going to go ahead and get the generic Vaughn's Albertson branded ketchup for the day, and it happens to be on sale for $2.99. Great deal. You're happy. It's ketchup, and we know that because it says ketchup on it, and it looks like it, and it's red, and it's got tomatoes in it, okay? But when you buy for your house, you're going to buy Heinz, and you're going to buy the organic, and you'll probably have it in your fridge for like 2 years, right? Because it's got a lot of preservatives, it's going to last. And that one just happens to have like really good quality tomatoes, no corn syrup, just really low sugar. They don't have any sugar added. That's FICO, right? That is the premier vendor, proven, just best, but it's more expensive, right? So we don't go and just get Heinz for the party that's going to throw away. We want to get the cheap one. But the cheap one has corn syrup, it has fillers and sugar and a bunch of crap in it, but it's still ketchup.
Right.
Okay. When we're now within Heinz, you realize there's actually 5 different varieties of Heinz. They've got spicy and organic and who knows what other ones, right? Same with FICO. So when you buy a FICO credit score, when you, meaning the bank, let's say Bank of America buys a FICO mortgage for their mortgage applications. They buy FICO auto for their auto applications, FICO credit card, FICO general. Just like Heinz, there's a variety of FICO models. It is the most predictive for that application type, which is why they have unique ones for each. So if I have auto history and my auto history is positive, my auto score might be my highest score because there's more experience and data. Okay.
Gotcha.
So understand within FICO, even if you tell me, Chris, on your credit card statement, you get a FICO credit score on that once a month and you love that and you rely on that, that's great. And I would ask you, what brand is that? Is it FICO, which it should be? Okay, great. And then it's like, what model is it? Is it FICO bank card, FICO general? Probably FICO bank card. And then I would even say, is it TransUnion, Equifax, or Experian? Because you're only getting one of your 3 bureaus. Okay.
Gotcha.
So all this information is great. Credit scores are great. I'm just trying to say is be careful because they're not equal. Even within the FICO models, they can literally be 50 points difference based on the application type that you're applying for.
That's interesting. I don't know how you keep all this separated, but I guess that's what 30 years of experience does, because it's like your mind blows when I listening to what you have to say is like my brain is going like this. It's spinning in circles. And I didn't realize there were all these little nuances to credit.
Well, and the sad thing is we're getting so much false information. Like if you go, even on the Credit Karma, I remember this commercial and it's talking about like tattooing your credit score on your arm.
Yep, I remember that commercial.
What credit score? And then it's changing every day because if you're a user of credit, every day you have account cycling or every few days. And so every day your credit score is changing because new data is coming in and FICO scoring a new score. So
Yep.
and there's just so much misinformation. And I'd say as an expert, that's my biggest frustration is as consumers, I'm so passionate about teaching, but it's really hard for me to give you your solution to your problem when I have to sit here and just go over some basic credit stuff, right? Because if I can't give you the foundation, it's really hard for me to explain the solution. So I created a credit clarity guide, and the credit clarity guide really answers why, when you go to Credit Karma, does it say your score is a 680, but then when your loan officer pulls your credit, they tell you it's a 580. And the guide says it's because credit scores differ by bureau, TransUnion, Equifax, Experian, by brand, FICO, Advantage, and by day. So if you guys want like just a little bit more clear information, the credit basics, I say read the free credit clarity guide. And I always ask my clients before I jump on their free consultation to please read that guide. That way, when we go to the free consultation, we've got 15 minutes to just talk about solution because we don't have to go through and debunk a bunch of
Yeah.
myths.
Yeah, and that's I've read that, and that is a very, very. It gives you a very good. I mean, well, I don't even want to say overview because it's very detailed.
Yeah.
Yeah, it's not. So it's not even an overview. It's like boom. If you pay attention to that, like, yeah, that's
I did record a very rough video on it too because I realized not everybody wants to read, and so I did recently add the video up there. I'll have to
yep,
reshoot another day. I mean, it's a
yeah.
little rough, but
But it was good. It was, and it has a lot of good information as well. Yeah.
yeah,
But
yeah,
by the way, the only reason I knew my credit score was because Wes at Movement Mortgage pulled it because I'm
okay.
got approved for a mortgage. And so I was like, yes, I was doing a little happy dance because it got to where I wanted it to be.
Good.
And that was my goal. But it takes time. It's not an overnight process, right?
Wes is awesome. You're in good hands with Wes. He
Yes.
knows what he's
Oh,
doing.
for sure. We just closed a deal on Friday. So yeah, it was smooth, very, very smooth.
Good.
Well, in the last couple minutes that we have, is there anything else that you wanted to mention
Oh.
that I didn't?
Yeah, I mean, right now there's a lot of information out there on Experian Boost, and that's when you add your rental history to your credit report. The only downside to that is it's only on Experian. Well, we all just talked about how we have 3 credit reports to 3
Right.
credit scores, right? So I don't love that product. The other thing is when you add an installment loan, which is how it's going to report, it takes about 9 to 12 months before your credit score recovers. So I use a different product called Rock the Score. I'm happy to give you my discount link on that. There
Okay.
is a fee, but it allows you to add your rental history to TransUnion and Equifax. But what I love is it goes backwards 2 years. So if you have 2 years of positive history, it's amazing because all within like a week, I believe I've seen them as quick as 7 days. It'll give you a 2-year-old account on 2 of your 3 bureaus. So for building credit quickly, especially in a mortgage situation where somebody has a little bit of a thin file and we're trying to get a mix of account types, which is 10% of your credit score, I believe. That could be a really good tool.
Oh, cool.
And then there was something else I was just thinking of. Yeah, I mean, I guess really just I start with a free consultation. I'm always shocked, like who wouldn't want a free consultation from a credit expert that
Yeah.
you trust? So
Yeah.
I don't care if you're at a 700 and you want to get to an 800, if you're 400 and you're recovering from COVID or some, major financial setback. My passion and goal is not to be judgmental, just to know that we're all going through things. We all have these life events. It's inevitable. It doesn't matter if it's death or
Mhm.
financial setbacks, family member, our own personal health issues. It doesn't matter. We're not always prepared to handle them financially. So maybe we've exhausted our savings and now we can't pay our bills on time.
Mhm.
I just want people to know that I've been there. We've all been there. And so
Yeah.
just come to me, trust that I'm
Yeah.
going to give you good advice. And if I can help you with the paid service, I'll offer it. As a matter of fact, you and I were talking earlier. There's often times where I don't have a service to sell you. I'm going to say, you're doing great. Here's a
Mhm.
other things you can do differently. And, I expect an increase of 50 points in the next couple of months if you just go off and do those 3 things. I give that to you for
Yep.
free. So
Yeah,
there's
and
really,
that's what happened with me. Yeah.
yeah,
Yeah, and you were just like, "Well, there's not much I could tell you to do differently," and I appreciated that. And the good news about all of this is we don't have to wear our credit score on our forehead, so nobody has to know what it is except for us.
yeah, yeah. It's so funny. I feel like I'm a doctor sometimes, like HIPAA compliance, right? Like I almost said, "Oh," and when I looked at your report, I was like, "Oh no, that's your information to share, not mine."
Yeah, exactly.
Yeah,
Yeah.
I just want everyone to be proud of their credit score. It literally is the most important score of our lifetimes. It helps insurance companies, creditors. I mean, what else is it used for? It's used for
Jobs.
jobs. Yeah, 65% of corporations use it to determine if they want to hire you. So
Yep.
there's so many reasons and ways our credit score gets used. It should be something we're proud of. And people have so much shame and fear and embarrassment, that they just don't want to ask for help. And they don't want to tell you, their realtor or their loan officer, that, gosh, my credit score is not where I want it to be. And so
Yeah.
they don't get the introductions to me because they just can't talk about it and they're ashamed of it. So
Yeah.
hopefully people watch us and go, gosh, you know what? I trust her. I want to just be the girl next door. I have a boutique company. I'm personally looking at these credit reports. And I love to help people. It feels really good to see the stories and see the pictures of them in front of their home, when they are able to close their loan.
That's awesome. So,
Yeah.
Nicole, how do people get in touch with you?
Okay. So my email is Nicole, Nicole, at b2cr.com. So that's short for B Squared Credit, but you can spell it out as well. And our number is 619-931-5190. And we are national, so it doesn't matter what state you're in. We have probably 60% of our volume in California and the rest are out of state. And yeah, doesn't matter.
That's good to know. Nicole, thank you so much for being here. I appreciate you very, very much. And yeah, trust me, you guys, I've used Nicole. I know people who have used Nicole, and everybody has just been super happy with everything. So thank you. Thank
Yeah.
you.
Yeah. Thank you again.
All right. We'll see you next time, everybody. Have a great day. Bye-bye.
Bye. Take care.